Starting this year, employees aged 50 and older who made more than $150,000 in 2025 will be required to make any catch-up contributions to their 401k plan in the form of a Roth. In this short video, we will share what you need to know and how you may think about incorporating Roth into your overall financial plan. Let's begin with 2026 contribution limits. Individuals age 50 and above can contribute an extra $8,000 to their 401k, bringing the total to $32,500. For those who are between the ages of 60 to 63 in 2026, your plan may offer an additional provision that allows for the catch-up to be $11,250 instead of the $8,000, bringing your maximum contribution to $35,750. Starting in 2026, if your prior year FICA wages were $150,000 or more, any catch-up contribution must go to a Roth 401k. The good news is that Roth contributions are held in the same 401k account as your other contributions. The key difference between traditional and Roth contributions is the timing of their tax advantages. Are you paying the IRS now or are you paying the IRS later, and on what balance? Roth contributions are made after tax, so withdrawals in retirement are tax-free, including any growth, as long as the distributions are considered qualified. You may be thinking that your income level is too high to take advantage of Roth savings. More good news, unlike Roth IRA accounts, there are no income limits to qualify for Roth 401k contributions. On the other hand, traditional 401k deferrals are made on a pre-tax basis. However, withdrawals in retirement, including growth, are taxed at your then ordinary income tax rate. Keep in mind that employer contributions are treated as pre-tax deferrals from a tax perspective, meaning when you take a distribution, they are considered taxable income to you. Lastly, Roth 401k dollars have the added benefit of not being subject to required minimum distributions. What makes a Roth distribution qualified? A Roth distribution is considered qualified when both of the following conditions are met. At least 5 years have passed since January 1st of the year of your first Roth contribution, and you are age 59 and a half or older, or the distribution is due to disability or death. Distributions that do not meet these requirements may be subject to income taxes on earnings and a 10% federal early withdrawal penalty if you're under the age of 59 and a half, and there are no exceptions. So let's talk about Roth 401k rollover considerations. Roth 401k rules can be complex, which is why many retirees choose to roll their assets into an IRA account or an individual retirement account after separating from service. Doing so can provide greater flexibility, as 401k distributions must be taken on a pro rata basis across all money sources. When you leave your employer, you may roll pre-tax 401k dollars into a traditional rollover IRA and Roth 401k assets into a Roth IRA, allowing you to choose which account to withdraw from before required minimum distributions may apply. One important consideration, rolling Roth 401k assets into a Roth IRA will restart the 5-year clock for earnings. However, this is often less impactful in practice because Roth IRA contributions are withdrawn first when taking a distribution from a Roth IRA. So that might mitigate some taxes. Here's a final thought on the topic. Distribution and rollover decisions should be tailored to your individual circumstances and made in coordination with your tax advisor. Let's consider the benefits of Roth dollars. Roth contributions are especially valuable if you expect to be in a similar or a higher tax bracket in retirement. However, even if you don't, there may still be benefits to the Roth. If you have been saving in the 401k for some time, it is likely that you have accumulated a significant balance in pre-tax dollars. Future Roth savings will help you diversify your retirement income stream in retirement and the corresponding tax exposure. Additionally, because Roth dollars are not subject to required minimum distributions, they may be a powerful legacy planning tool. If you expect to be able to support your retirement lifestyle using resources outside of your 401k, or you have other resources that would mean your 401k would not be fully distributed within your lifetime, you may not need to distribute all of your Roth dollars, allowing them to continue growing tax-free throughout your lifetime and potentially even beyond as part of your legacy. The good news is that there's nothing you have to do. Your payroll and benefits team will ensure that your catch-up contribution is made in the form of a Roth. As part of your personal retirement planning journey, you may consider how Roth dollars fit into your overall financial plan. You do have the option to contribute a portion or all of your standard contribution in the form of a Roth, in addition to the catch-up dollars that we've spoken about today. We wanted you to be aware of the new Roth catch-up contribution requirement. However, it's also a great opportunity to revisit your 401k contribution strategy. Thank you.